Skip this for now. I'm going to move on to, just going to talk about the first case. Okay, so for maturity value of the bonds, if we're issuing the bond, this first entry here, just like a regular borrow money entry, except that we're switching short-term notes payable to bonds payable. Okay, earlier we're talking about long-term notes payable, mortgage payable. Once we issue a bond, let's say the dollar amount given to you is $100,000. You issue multiple bond certificates of 1,000. You issue 100 of these $1,000 bond certificates. Interest rate is 9%, and let's say assuming the market interest rate is also 9%. This 5-year bond, the first day when we issue it, we receive the cash from creditor. This is a journal entry that we journalize the issuance of bond at maturity value. The entry of the issuance only looks like this if the interest rate matches. 9% of stated interest rate equals market interest rate 9%. Okay, on Wednesday we'll cover the second and the third cases. First issuance entry will not look like this. Okay, so this is the first type, equal interest rates and market interest rate. Second entry here, half a year later. Remember that bonds, we usually pay interest half a year later, semi-annually. So half a year later, interest expense, just like how we calculate short-term notes, long-term notes interest, principal amount times interest rate times half a year. Okay, the time period is half a year because bonds interest is usually paid off half a year. So meaning that you'll have this journal entry June 30th, you will also have this journal entry December 31st, exactly the same. And this part here will not change because here we're not paying by installments. The full amount, $100,000, will be paid at the end when the bond matures 5 years later. So throughout the 5 years, every half a year, the journal entry will look exactly the same as this, okay, for the next 5 years. Because it's yes, it would always be 6 over 12, and this part, principal amount would always be this, $100,000, okay, for this case. Okay, so the third entry here, what happens when we paid off the bond, when we collect the, when the company pays off the bond to creditors. You want to guess how we journalize this? Well, since we paid all the interest half a year, so we got rid of the interest part. So we're just left with the maturity value. Okay, so the third entry, again, would always be whatever you borrowed, whatever is listed on the face value of the bond, maturity value of the bond. Okay, so there are 3 main entries to bonds. First, when we issue the bond, collect cash, credit bonds payable. Second, when we have interest expense accrued, interest expense paid off every half a year. This part is not accrued, it's actually paid off semi-annually. And then 5 years later, when it reaches 2018, we're just paying off the entire maturity value. So debit, liability, credit, cash. So there are 3 entries to this first case. When interest rate matches, first entry, last entry, we're just flipping it.